Okay, continue from the previous video. This is the second part of the video for this lecture. So I'm gonna change it to presentation slides. Show. Okay, history, level of risk and return. As you can see here, investment that produce higher returns have higher level of risk associated with them. From this figure risk-return relationship, you can see that common stocks usually have a higher return. At the same time, it also holds high risk or variability of returns. It has a risk, so higher risk, higher return. And treasury bills are government secured security, which actually give you the lowest interest rates because it is backed by the government. The government will definitely give you back whatever return that they promise for the year. Okay, so that it has low risk and also low return. Okay, other sources of risk in the risk return trade-off are these types of risks, which you can call it inflation, interest rates risk. Okay, this risk of fluctuation in security prices due to the changes in the market interest rates. Yeah, so the fluctuation of or the volatility of interest rate risk actually is a risk that makes your stock prices goes up and down. Inflation rate risk is actually the risk that rising prices will eat away the purchasing power of your money, and that changes in the anticipated level of inflation will result in the interest rate changes, which will in turn cause security price fluctuation. Meanwhile, business risk is the risk of fluctuation in security prices resulting from good or bad management decision, or how well or poorly the firm's products are dominating the marketplace. So, and then lastly, we have financial risks. These are the risks associated with a company's use of debt. If a company takes on too much debt and can't meet its obligation, investors risk the company defaulting or dropping in stock's value. That's inflation risk. Yeah, and then we also have liquidity risk. Liquidity risks are risks associated with the inability to liquidate a security quickly and at a fair market price. So you are unable to change the security into cash immediately. And market risks are risks associated with the overall market movement. And we also have political and regulatory risks, which are the risks resulting from unanticipated changes in the tax or legal environment of a country, changes in the political bodies who govern the countries also are in this category. Then we also have exchange rate risk, the risk of fluctuation in security prices from the variability in earning resulting from changes in exchange rates. And lastly, we have call risk. These are the risks to bondholders that a bond may be called away from them before its maturity. So the anticipated return that you will get is lower than what is promised to you. Okay, what is diversification? It's actually a method to eliminate the risk by investing in different assets. So it allows extreme good and bad returns to cancel each other out, and it reduces risk without affected expected return. So there's a saying, do not put all your eggs in the same baskets. This is all about diversification. So if one assets drop in prices, another one will pick up in a different market that will pick up in prices, so it zeroize your losses. So how do you diversify? You diversify by forming a portfolio that is a group of investment held by an individual, a group. Okay, so you can either invest on a systematic or market-related or non-diversifiable risk that are the portion of securities risk or variability that cannot be eliminated through diversification. For example, you have interest rates risk because it affected the entire market, so it cannot be eliminated. Meanwhile, unsystematic or firm-specific or company-unique risks or diversifiable risks are risks of variability which can be eliminated via diversification. So this the figure 111.3 is showing the reduction of risk as number of stocks in the portfolio increases. So the more portfolio you have in your the more number of stocks you have in your portfolio, the lower the risk, the smaller the risk that you will get attached to it. However, in this graph, it shows that there are certain risks that you cannot diversify away. It will happen, for example, political. It will go across the entire stocks. For example, the incidence of this pandemic, COVID-19, it actually affected the entire range of stocks, so it cannot be diversified away. Meanwhile, the unsystematic or diversified risk, you can actually diversify it away. Okay, the more stocks you have, it reduces the number of risks that attach to your portfolio. Okay, and then before that, you need to understand your level of risk tolerance. How much risk can you take? You need to recognize it, okay, and invest according to your risk tolerance. Take one of many risk tolerance tests. Review your past action. Here in figure 11.4, there are risk tolerance questions, and if you can find out in this one, in each of these questions, you have a point there. So be honest with yourself. Do this test, be honest without looking at the point, so it will tell you at the end a total score, and for 5 to 13 points you have a very low risk tolerance, and 14 to 20 points you have high risk tolerance. So what if you have a low risk tolerance? You are more risk adverse. Okay, you should attempt to learn more about risk return trade-off. You should make sure you are adequately diversified, focusing on safer investment, and attempt to add riskier investment as you gain better understanding of investing. Meanwhile, if you have higher points, 14 and above, you have high risk tolerance, meaning to say you are less risk adverse. You are more comfortable with risky investment, being drawn to investments such as common stocks rather than money market accounts or certificate of deposit. You should make sure your portfolio is adequately diversified. So this is the kind of risk tolerance quiz that you should take before to identify your level of risk tolerance. And then we have the time dimension of investing and asset allocation. As the length of investment horizon increases, you can afford to invest in the riskier assets. If investment horizon is longer, will probably end up with a lot more if you invest in some risky investment. So it depends on how long you want to hold up your investment. The longer you hold it, and eventually you will gain more than in the risky assets. With any long-term investment, there will be a bad years and good years. With time, dispersion or variability of returns in these years converge towards the average. What kind of asset should you invest in? Investment in bond will give you less uncertainty over time, but will give you smaller ultimate value than investing in riskier assets like stocks. So this is an illustration of the reduction of risk over time from 1950 to 2010. So eventually it gives you a higher, you look into treasury bill, 20-year holding, 5-year holding, 1-year holding, and it shows what is the average range of returns that you get. So it will give you an average out of it. So if you invest in the riskier assets, it gives you higher returns. If you invest in the safer investment, it gives you this much of return. Alright, we move to assets allocation. How your money should be divided among stocks, bonds, and other investment. So investment diversified in different classes of investment. Common stocks are more appropriate for long-term investment. Asset allocation is the most important investment task that is not a one-time decision. Okay, asset allocation is an attempt to assure that investor strategy reflects he or her investment time horizon and is well diversified, generally with assets in several different classes of investment, such as domestic common stocks, international common stocks, and bonds. Okay, this need a long time. This need sometimes to plan. Yeah, it's not one-time decision. Okay, factors impacting asset allocation decision. First, time horizon. Second, financial situation or capacity of risk. And thirdly, risk tolerance. Okay, please read this on. So, investment horizon is quite long. Investors should place majority of savings into common stocks. These are for through age 54. 80% common stocks and 20% in bond is quite common. Okay, that is how you allocate your assets. Preserve level of wealth and allow it to grow, and start moving some of investment retirement portfolio into bonds and maintain a diversified portfolio. So as you for golden years, for approaching retirements, ages 55 to 64, own 60% stocks and 40% in bonds. Yeah, okay, this is for a mixture for golden years. For over 65 years old, spending more than savings. Income primary, capital appreciation secondary. Okay, income is primary, capital appreciation is secondary. Safety through diversification and movement away from common stocks. Own 40 stocks, 40 bonds, 20% T-bills. Later on, 20 common stocks, 60% bonds, and 20 T-bills. Yeah, this is for during retirement years, how you allocate it. So next, what should you know about efficient market? Efficient market is a market in which information about the stock is reflected in the stock price. Again, in efficient market, there's no way to beat the stock market with information that you get. The more efficient the market, the faster prices react to new information. There's no way to get information earlier and to make money. Okay, if the stock market were truly efficient, then there would be no benefit from stock analysis, because whatever price is actually reflecting all information that you get. Beating the market, half the time you should outperform the market and half the time you should underperform. So it's difficult for superstars of investing to pick up underpriced stocks and time the market. Keep your plan invest for long term. If you try to time the market, you're just as likely to miss an upswing as you are to avoid an downswing. Okay, this is an advice. Okay, you are an individual investors. There are other large corporations out there are actually hiring special analysts to actually beat the market. They are better off in terms of knowledge. They are better off in terms of information. So as an individual investors, the best is actually to invest for a long term rather than actually trying to beat the market. So what does your understanding of efficient market tells us about investing? It tells us several things. System does not beat the market. It's long-term investing that works. Okay, so keep to the plan. Do not try to time the market. Keep in mind that stock prices and interest rates goes up and down, and it's almost impossible to buy only when the stock's price are down and sell only when the stocks are high. So you should focus on your asset allocation process. You should spend your energy on appropriate assets allocation given your goals, your plans, and where you want your financial life cycles, where you are in your financial life cycles. Yeah, keep the commission down because it is difficult to beat the market, and make sure you don't give away too much of your return in the way of commission. Diversify. The benefit of diversification are still unchallenged. And if you don't feel comfortable, seek help. Don't let the fear of investing keep you out of the game. If you feel uncomfortable, seek the help for a qualified financial advisor. Okay, and then thinking back to principle 9, the mind game, and also your money. Sorry. What is overconfident? Okay, investors tend to be overconfident. Simply put, people think they know more than do. Okay, they think they know more than they do. So this overconfidence applies to their ability, their knowledge, and their